Hey everyone, welcome back to the Foundry by Forge College. So in our last explainer, we dug into the foundational mechanics of block rewards, right? We looked at the incentives driving them, and of course, those famous halving events. Well, today, we are putting it all together. Our goal here is to bridge those technical mechanics of mining with the cold, hard economic realities of the market.
Okay, let's dive into this. Think of today's agenda as a mechanical system schematic we're going to build step by step. We'll start with the security budget blueprint, run a halving stress test, check out some minor survival strategies, and wrap up with equilibrium and trade-offs.
All right, part one, the security budget blueprint. It is all about Bitcoin's balancing act. To truly grasp how Bitcoin operates in the long term, you have to understand that its security isn't just a bunch of computers crunching math. It's fundamentally an ongoing economic balancing act. And our crucial starting point is the security budget. Now, what is that? It's the implicit flow of resources made up of block subsidies and transaction fees that essentially pays for the hashing power securing the whole network. Notice I said implicit. This isn't a literal bank account or some escrow fund. It's a dynamic ledger of incentives that attracts miners to do all the heavy lifting. So let's look at how this ledger actually balances. On one side, you've got your inflows, right? The newly minted block subsidy and the transaction fees paid by users. On the other side, you have the outflows, hardware, power, cooling, maintenance, paying your staff, the whole shebang. It's a pretty fascinating dynamic. When inflows are high and margins are wide, miners will literally plug in every single piece of equipment they can find to capture that revenue. But those outlays, they are relentless. The electric company wants to get paid regardless of what Bitcoin's price is doing today, and that sets the stage for some serious economic tension.
Moving on to part two, the halving stress test. Let's see how resilient this system really is.
We're going to run a mechanical stress test here and anchor these abstract ideas to some real concrete numbers. Now, what's really interesting is how abrupt this change is. Let's say right before a halving, the subsidy is 6.25 Bitcoin plus an average of 0.5 in fees. That gives us a total reward of 6.75 BTC per block. But the second that halving hits, boom, the subsidy drops by exactly 50% to 3.125. Assuming fees stay flat, your new total reward is 3.625 Bitcoin. That is a massive 46.3% drop in your total reward, literally overnight. That 46.3% chunk represents a massive lost revenue shock. To put that into everyday perspective, imagine waking up and realizing your favorite local coffee shop just doubled the price of your daily latte, but you are still making the exact same minimum wage. Yeah, it hurts. If your operational costs were barely covered before the halving, this sudden shock means you are instantly operating in the red. Which brings us to Section 3, Miner Survival Strategies. How do you even adapt to a shock like that?
Well, we basically have two main players on the board. On one side, we have our marginal miners. These are operations with higher per-unit costs, often paying standard retail electricity rates. They are highly sensitive to market shocks. On the other side, you've got the large operations. These giants have lower marginal costs, durable bulk power contracts, and hyper-efficient cooling infrastructure. When a halving hits, it's the marginal hobbyists who start sweating. They feel that 46% revenue drop right in their bones. Meanwhile, the industrial giants barely flinch because they locked in massive, cheap.
So, what do those marginal miners actually do? They scramble into defensive preservation mode. They'll immediately try to negotiate temporary power rate adjustments, and they'll delay any non-essential capital spending. So actually, scratch buying new machines. That is totally out the window. They might also consolidate their hash rate into mining pools to smooth out the variance in their payouts, all while obsessively monitoring fee trends, just hoping demand spikes enough to save their margins. Really, they're just trying to keep their heads above water.
But on the flip side, this brilliantly illustrates the ruthless efficiency of the free market. Opportunistic expansion. Those large, low-cost operators actually use the halving shock to go on the offensive. They swoop in and acquire used equipment at a steep discount from the marginal miners who are forced to capitulate. They absorb those smaller miners' power contracts, and ultimately they increase their overall network market share. It's wild. One miner's crisis literally becomes an industrial giant's expansion opportunity. And that brings us to Section 4, equilibrium and trade-offs. Let's see how the whole system rebalances itself.
Now we need to understand how all these individual, somewhat selfish decisions roll up into this beautiful mechanical feedback loop. Step 1, the block reward drops abruptly because of the halving. Step 2, marginal miners who are now bleeding money unplug their unprofitable rigs. Step 3, because those machines are turned off, the total network hash rate falls. Now, If this were a normal corporate system, that might trigger a complete death spiral. But look at step 4. Difficulty adjusts downward mechanically. The protocol recognizes blocks are taking too long to find, so it literally makes the math easier, which leads directly to step 5. Profitability partially restores for the remaining miners. It's just an incredible organic built-in damping effect.
But, there is no free lunch. This incredible survival mechanism introduces the ultimate trade-off for the whole ecosystem: centralized resiliency versus decentralized fragility. As those marginal distributed miners exit and the large, low-cost hubs consolidate and expand, the network retains highly durable hash power. It stays very secure. But it faces higher operational and regulatory risks because that power is now concentrated in fewer locations. On the flip side, widespread participation gives you a really strong decentralized edge, but it's highly vulnerable to those planned reward reductions. The network is constantly balancing on a wire between the two.
Which leaves us with a fascinating and honestly pretty provocative thought to end on. If block subsidies are designed to eventually drop to zero, will transaction fees alone be enough to secure the network? It is absolutely the ultimate question of Bitcoin's long-term economic model. And will it tease up our next explainer perfectly, where we'll dive into the specific hardware choices and operational metrics miners use to survive in this exact environment. Thank you so much for joining me today. I highly encourage you to visit forge.college to learn more about this subject, explore other resources, and dive deeper into the vast world of Web3. Keep learning, and I'll catch you in the next one.